Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Energy Leases, Oil and Gas. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1.5 CPE credits. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 75 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only one sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters from Moss Adams. We have Jordan Whitten, partner, and Brad Ullrich, senior manager. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Brad to get the presentation started.
Thanks, Amy. Can you hear me all right?
Yes.
We got you.
All right. Hello, everyone. Thank you for joining us today. This webcast actually builds on one that Jordan did previously related to the energy industry as a whole, which covered more technical guidance and concepts, but a little higher level. But today is supposed to be more of a deep dive into oil and gas specifically to show kind of some actual examples of what it looks like, and then the general overview to start on what to expect, some tips for implementing for your company, and then how to perform a contract analysis on any contracts that you may need to look at, as well as contracts that you might want to follow in that bucket. So hopefully by now you all have been told many times what the guidance is for with all the delays they've had. But the main goal of it was for lessees to present all leases with terms greater than 12 months. You'll see at commencement there is underlined because it doesn't mean 2 months or 12 months from implementation date. And Jordan, if you want to talk on that a little bit more.
Right. Excuse me. Sorry. So the idea there is if as of commencement date on the short-term exemption being if you had a 2-year lease that has say 12 months left at adoption, that does not qualify for the 12 months short-term exemption. So that would have to go on the balance sheet at adoption. Now, what's a little interesting about that is by the end of the year, it would have rolled itself off the balance sheet, but it would roll through all the required disclosures and be on the balance sheet at adoption, and then if you were to renew that that lease for another year, it would stay on the balance sheet. Once you're not eligible for a short-term exemption, you can't be eligible for a short-term exemption. So a little nuance there, and also even if the leases that are 12 months are not required to go on the balance sheet, there are specific required disclosures on those short-term leases, other than very short-term leases being month-to-month type leases. Go ahead, Brett.
Thanks, Jordan. And forgot to mention earlier, but if y'all do have a question, please put it in the Q&A. We have Luke with us here in Denver monitoring it and letting us know when those pop up, but we are going to try to hold them till the end to make sure that any questions that would be answered later on are answered, and make sure we have enough time for the material. The last bullet point here, any leases for oil and gas or mineral rights, these are out of scope for 842. You'll still account for oil and gas leases under the same guidance and methods you did before. And then we're here for our first polling question. I'll hand it to Amy to open it up.
All right, thank you. So the first polling question, we are going to have 6 of them throughout the webcast today, but the first one is, what is the best description of your progress thus far with topic 842 implementation for your business? And it looks like our presenters have some fun responses down below, so read through those and submit your answer. And we will give you a few moments to respond. To respond, you will need to click the button next to the answer you choose and hit the submit button. And then if you can't see the submit button, just enlarge the slide area.
So unfortunately, you all are unable to see my beautiful hairline there, but probably can hear me breathing through the phone. So with friends like these, who needs enemies is always what I have to say about that.
Wise words, Jordan.
Seeing some questions come in as we wait for a few more folks to get through the polling question. We will get. We're about to get into to one of those specifically, so if we had a 2-year lease originally at commencement prior to 1/1/22, but there are only 8 months left at 1/1/22, it does not fall under the short-term exemption. So it would have to go on the balance sheet at 1/1/22 and forward. So it would not fall. It would not qualify as a short-term lease exemption under the standard because it was greater than 12 months at commencement.
To elaborate, you would use your remaining months for your calculation, so it would be the 8 payments remaining, but it would still be part of your balances that you bring on as of 1/1. And that's really only going to be, like Jordan said earlier, in your disclosures and your financials, because otherwise it'll shake out throughout the year.
Right, or any interim periods. Yeah, there's some nuance there, but the concept is, yes, it would go on. And we'll actually get into a little bit of discussion on the lease liability calculation as we go forward. So there we go. An equal rate of people like me and hate me. So we'll go from there. So thanks for that.
And then another question was about easements.
Yeah, that's what we'll get to that one
shortly.
We're about to get to that one.
All right. Well, looks like equal Darth Vader, equal good-looking firm, but most of you have a plan in place but have yet to execute it. That's great. You have a plan, and as auditors, naturally, we encourage you to get it executed before year end. But I think having a plan is a great first step. So this kind of summarizes the financial statement impacts. The P&L under operating leases, if you recall, were just affected by straight line rent. So you just had a straight line rent lease expense. The FASB did not want that to change. They didn't want to have any P&L impacts, and it currently doesn't. The way right of use asset and liability, when they're brought on, the way they're amortized down results in the same expense you would have as before. In terms of cash flows, operating leases are in your operating section kind of indirectly through your reconciliation of current assets and liabilities. Each of these have a right of use asset and lease liability, but are presented separately. Finance leases are formerly what was known as capital leases. Those are more kind of in the debt type liabilities, whereas operating leases are in operating liabilities, short-term and long-term. In terms of what the implementation will look like, and should say the best scenario of what it would look like is kind of described here. The first step, scoping and assessing the impact, getting a pool of all your contracts that may involve allowing you the right to direct the use of an asset and be the primary user and beneficiary of that asset. Whether it says lease or not would be a contract you'd want to have in that phase one of scoping how many contracts you need to look at and best way to approach it. You can do a portfolio approach, meaning that if you have many leases, but most of them are of 2 or 3 different types, you can look at it in 3 buckets instead of individually. For your lease analysis, determining if it's a lease, and then after that point, if it's an operating lease or a finance lease. In terms of new processes and controls, many companies are using a software designed to account for leases, or may have a module in their ERP that helps with it. Doesn't need to be necessary, but you will need to have a whole new set of controls and processes to make sure that every new lease is captured and brought on the books properly, and that going forward, the entries with every payment and amortization entry, that it's recorded properly. And then at year end, making sure the lease disclosures are complete and accurate. So where to start? Obviously, the first step is ensuring leases under the old guidance, which was ASC 840, are accounted for correctly. Some examples are there. Tenant incentives previously were capitalized and slowly amortized over the life of the lease against lease expense. Deferred rent was a result of straight line rent compared to cash payments, and any indirect costs that were capitalized or should have been capitalized, they do need to be capitalized before you implement 842. So if you had kind of passed on doing a deferred rent or straight line rent before, theoretically you would want to true that up right before adopting 842. And then, like I said, going through your listing of contracts. Sorry, go ahead, Jordan.
No, you're okay. So to that first bullet point, and also we'll get into this a little bit here with the expedients. There are those expedients that allow us to carry forward the existing classification for existing leases as operating or financing, and the others we'll talk about. But it does not allow us to carry forward incorrect assessments under previous guidance. So if we don't have to assess those things under the new guidance, when we elect the expedients, but we get to carry it forward. But we don't get to say that we did it wrong then, but it's okay because we're just carrying it forward, right? So we do, we're not grandfathered in incorrect conclusions, basically. So there's something to remember, and something not just blow past, I guess.
Yeah.
Go ahead, Brad. Sorry.
Oh, no worries. Appreciate all your input, Jordan. The next bullet point, so if you're really unsure, you have no idea what contracts you have, and this is what auditors would do to see if there's any leases that we aren't already given, looking at, 12 months or so of historical disbursements, looking for recurring payments or vendors that might indicate a lease, like if there's a $500 monthly payment to forward every month, that might be something to look and see if there's a lease for it. On top of any other processes you'd think would be more efficient to make sure all the contracts you need to look at or need to consider are in front of you. And then the last bullet point, which we're getting into next, is about the practical expedience, which are always a good election, in my opinion. Any shortcuts you can take, well, why not do it? So these are the majority of the practical expedients that have come about for 842 for private companies. The first one is a package of 3, and it allows you to do what Jordan was discussing. You don't have to reassess all expired or existing contracts for embedded leases, proper lease classification, or capitalization of initial direct costs. And so that's saying if previously you had a lease that you determined was a capital lease on the implementation date, assuming that contract wasn't amended, or isn't a new contract, you can call it a finance lease without doing any assessment of if that's right or not. But again, you want to make sure that your prior classification was indeed correct. Embedded leases refers to the old guidance when a contractor transaction might have a lease embedded that needed to be broken out and bifurcated. Not super common, but it does happen. But anything like that would be treated the same on day one. And land easements, again, as long as you accounted for them correctly before, you continue accounting for them the same way until they either end or are renewed or amended, sorry. So if you were capitalizing your right-of-way costs and amortizing them, that treatment would continue at 1/1/2022. The next one is about short-term leases, which we kind of discussed earlier. You may elect to exclude leases of 12 months or less from the accounting requirements. However, you do still need to track the payments for those leases and disclose them. Other than those, Jordan can correct me, if they're a month or less in term, those would be not required to be in the disclosures.
Nope, all good. So just a couple of clarifications, though, just because I can't sit here being quiet for too long. So that first row there, the package of 3, if you elect, you have to elect all 3. You cannot pick and choose between those 3. So what that's saying, and this kind of gets to one of the questions in here about from Mr. Dale of we would if we have our existing leases, we would carry them forward. If we previously classified them as operating leases, we would bring them forward at 1/1/22 and go forward with them as operating leases. We would measure the liability recorded on the books and go forward under the operating lease treatment with the straight line expense, unless we modify, amend, or enter into a new one. So if we modify any of these leases, if we extend any of these leases after 1/1/22, we don't automatically get to keep that previous classification. So that could be very troublesome if we have leases where we have brought them forward as operating leases, and then we extend them and in 22 at some time, and we may end up in where we're in a finance lease situation. And maybe not, but it's something to be aware of. So the land easements, and we actually have a slide on it, but to be a little bit more specific there, to the extent that easements were not previously classified as operating leases or finance leases, but if we did not account for them as leases, we do not have to assess existing or expired land easements for lease accounting. But again, if we amend, extend, or enter into any new ones or acquire any new ones after 1/1/22, we would have to assess those under 842 for potential lease treatment as to the identified asset and some of the stuff the identified asset and directing the control of the asset. And just because I'm talking too fast, I'll go ahead and answer another question on non-operated properties. So if you are a non-op and the operator is entering into compression agreements, vehicle agreements, whatever it may be, if you as a non-op do not have the ability to make the decisions as to how that compressor runs, when it runs, then you do not have the ability to direct the control and use of that. Control and direct the use of the asset. I would be stunned if there are JOAs where a non-op has control effectively, and would have to put them on. So there may be some very unique scenarios where non-operators would have to put leases on their books for equipment used in the oil and gas operations. So absent that, I would not expect non-ops to have right-of-use assets and lease liabilities. So those first three rows there are expedients that we get to elect upon implementation and adoption. Those last four are actually accounting policy elections that we go forward with. And to Ryan's question, yes, if we have a 18-month 18-month contract that commenced on 6/30/21, yes, it must come on the balance sheet at 1/1/22.
And Jordan, do you want to maybe touch on if what you've seen in regards to new easements, if they're qualifying as leases when under the new guidance?
Yeah, I thought we had a slide that was specific to easements, but maybe not. So I guess on those, it comes down to this assessment of, controlling the asset, right? So do we have an identified asset, which would be a parcel of land or a strip of land or something of that nature? That would, in all likelihood, very much be an identified asset. But do we receive substantially all the economic benefit, and can we direct the use of that asset? And in that scenario, it's really, can we restrict the landowner's access to the portion of land, that use of the land, and those types of things. If we can, then it's perhaps, yes, we have a lease. It feels a little conservative, but it does happen that way. There's also this notion that that air rights cannot be a lease, and so if that pipe that you have a right of way for is up in the air somehow, that you wouldn't have a right of use asset and a lease liability, because we all have allegedly access to direct the use of oxygen. So I think it's just something to be aware of and take a look at. If we have really restrictive rights on land, then yeah, we may have a lease. Absent that, again, it could happen, but it's really a judgment call in taking a look at the specifics of each contract. And then just, again, because you got the fat guy talking, down here on the risk-free rate, that's actually worded incorrectly. Someone should have reviewed the slides. Same guy. So there's for private companies now, you're allowed to elect the risk-free rate for each class of asset or each lease based on a risk-free rate that is similar in term to the lease term. So leases with a 2-year term would have a 2-year risk-free rate. You don't have to worry about if the borrowing, the borrowing rate is irrelevant to that. You can elect to use the risk-free rate if the rate is not implicit in the lease. And so if you cannot readily determine the implicit rate in the lease, then you are permitted to use the risk-free rate based on a similar term to the lease itself. Regardless of any elections you make, if you can determine that, sorry, I got distracted like a cat by the question. If you can determine the implicit rate, you have to use it, period, no questions. If you cannot determine that implicit rate, then yes, you can use the risk-free rate. Or you can elect to use your incremental borrowing rate. And yes, subsurface rights, yes, can be determined to be equivalent to air rights. So there would not be exclusivity in that situation. They would not be an asset you have the ability to direct the use of. And then, so as far as litigation is required, so when we talk about lease, what goes into the lease liability is based on the remaining lease in substance fixed payments, as well as any variable payments tied to a rate, and as well as any, minus any lease incentives. So let me get back to you on the question about the litigation. There may be some nuance there. So the question, I apologize, is if litigation is required to secure land use agreement, is the cost of litigation capitalized? There may be an argument that is a cost to obtain the lease. Let me take a look, and I will follow up with you on that. An industry where everything, you learn something every second of every day.
And Jordan, a question I get sometimes is whether, when you're implementing, do you use that risk-free rate that was applicable when that lease started 10 years ago, or are you allowed to use the risk-free rate at 1/1/2022?
That's a great question. So when we implement, we are using the remaining payments as of 1/1/22 to calculate our lease liability. We would then use the risk-free rate as of implementation date, as of commencement date. As that risk-free rate changes, we don't touch the liability. We allow it to go forward, nothing happens. If we modify that lease and have to remeasure and recalculate the lease liability, we would then use the risk-free rate as of the date of the modification to calculate our new or remaining liability. So again, and if, no, public companies are not permitted to use the risk-free rate on that one. So again, if we entered into we enter into a lease on 6/30/22, so it's not an adoption one, it's a brand new one, we would use that risk-free rate as of commencement date over a similar term. Everything is looking forward on that lease liability. And one item we skipped here because I got involved erroneously, these lease and non-lease components. So a lease and non-lease component would be, so our lease component, we have an agreement for a compressor that has a base rent, identified asset, as well as maintenance charges or maintenance services, repairs, things of that nature. The lease asset, the identified asset, the compressor, is your lease component. The non-lease component would be the service costs. The easiest example of this is an office lease, where you have your office space as well as common area maintenance and cleaning crews and some of those charges. The lease component would be your rental space. The non-lease component would be that common area maintenance. If the standard is that you would take those lease payments, again, the in-substance fixed payments, the monthly rent, and any variable tied to a rate. You take all those lease payments and then allocate them across the lease and non-lease components based on their relative standalone value, which is splitting the atom. Or you can elect to not separate the lease and non-lease components by class of assets. We'll stick with risk-free rate for a moment. If the agreement was entered into 10 years ago for 15 years, the discount rate is the risk-free rate at 1/1/22, correct, for a 5-year lease term, right? Because if a 15-year lease we entered into 10 years ago, we have 5 years remaining at 1/1/22. We would use the discount rate, the risk-free rate at 1/1/22 for a 5-year instrument. So again, on the lease components, that would be your asset. Each vehicle, each compressor is a component. If you have an agreement that has compressor and an amine unit, those would be 2 separate lease components. So you would be required to you're required to separate those as well as separate your non-lease components, or you can elect by class of assets to not separate them. The result of not separating them, certainly a larger liability, far less complexity, larger liability, larger asset, and maybe save some people some headaches.
And your question, Abigail, is right at the end. That would just be a disclosure. In your financials, would just be a disclosure.
What's that? I'm sorry?
Sorry, looking at an old question. Continue.
Okay, sorry, I didn't see anything about that.
Maybe want to mention that there's also a term, and I wish I was joking, called non-components, which is different than lease and non-lease components.
If we want to really confuse the heck out of everybody, yes. There are also these things called non-components, because we're making up words, which would be administrative fees or reimbursing the lessor for their administrative costs. Those basically get grouped into our lease liability payments. They are not separately identifiable as either an asset, a lease component, or a service, a non-lease component. So again, if we elected not to separate those, any fixed or in-substance fixed payments, as well as again those variable ones tied to a rate, would all go into the calculation of the liability one time. So I think there's that, and then so yes, sorry, Andrea, to your question before we move on, and we run when we run our expense for an operating lease, and I apologize, I should read the question. If a lease is a lease, you can bill out to joint interest. You reclass your share to show as lease cost, but your liability as a whole. Yes, you are legally obligated for the entire liability. When you run your JIB, you're going to net.
Jordan?
Yes, sir?
Could Amy open up the polling questions, and they can resume answering the question, the next one, so we can make sure we get through everything?
Yeah. I figured you wanted to answer questions. Yes, you would then run your JIB and bill out your cost, your expense. All right, sorry. There's the polling question.
Yep. It's talking about pre-existing easements or right-of-way contracts, and just asking how they should be accounted for, if it should be accounted as an oil and gas lease, as a one-time expense, or in the same manner that they were previously.
This is Amy. I'm going to jump in real quick while everyone's responding. But I just want to remind everyone you do need to respond to at least 5 of the 6 polling questions that we pull up. And we will leave this one up another 5 seconds or so to make sure you get your CPE. All right, here are the results.
All right. The answer is B. And really, it's a general answer that any leases or any contracts that might be a lease after 842 that you've had previously, the practical expedient allows you to just keep treating it the same way and accounting for it the same way.
Yeah, so, sorry, the answer, I thought you said B. No, it is not B, it's C. I didn't hear you, did I? All right, cool. So, sorry, these questions are really important, and so I don't think we should rush through the discussion on the JIB. This is vital to the oil and gas industry. Sure. So, I guess, correct. Your non-ops are still on the hook for their portion of any JIB, right? Of any of these equipment costs. That hasn't changed, right? So when you pay the actual monthly cost or that monthly expense and you run your JIB, you should be running the expense through, right? and netting that, collecting from your non-ops or netting that against revenue, however that's working out. So yes, I guess there's probably a lot of follow-up to that, but the liability is an 8/8 situation, right? The liability and the asset are both 8/8. But as you're working that off and you're running your operating expense down, right, you will be billing that through to the non-ops the same way you would any other piece of equipment. I hope that was sufficient. It may not have been, so please let me know.
All right.
It was the sound of silence.
And we do appreciate all your questions, and we just ask patience because we're getting to the examples at the end, and it might be good to answer some of them by showing the mechanics of some of the answers.
Right, but to that, we didn't actually build the JIB process into the examples, so.
True, yes, we did not. That was a great question. This is actually stolen, actually many of these slides are stolen from Jordan's last presentation, which that is the one that had the land easement slide in it. But this just kind of outlines the process for if a contract is in the scope of 842. Again, there's an identified asset and the right to control or use that asset. The decision-making authority, whether, and this actually is a good one that I'll ask you to chime in again, Jordan, about the substitution, ability to substitute, and whether it would be economically beneficial to substitute it. Want to touch on that briefly?
Yeah, sorry, I was looking for the mute button. So the supplier has no practical ability. So if there's actually a pretty good flow chart here that will even answer the question easier. So is the piece of equipment explicitly specified in the contract? If the answer is no, is the piece of equipment implicitly specified at the time the asset is made available to the customer? So if at the time the asset is made available to the customer, we have a compressor with X amount of horsepower, that is an implicitly identified and specified asset. If for some reason the lessor can switch that out for a smaller compressor that's cheaper for them but charge you the same rate, then they would have an economic incentive to substitute. If we are not aware if they have an economic incentive to substitute, then it is presumed that they do not have an economic incentive to substitute. So the example I told Brad last night was, say I have a lease for a Ferrari, which I do not. If I have a lease for a Ferrari and the lessor could switch that out for a jalopy and charge me the same rate, that is an economic incentive to substitute. So without something kind of like that, then that wouldn't be the case. So as well, while we're here, the identified asset. So is the asset physically distinct? So again, that compressor, that rig, that vehicle is physically distinct. You don't need the VIN number per se, but it is a Ford F-250 is physically distinct, right? So from that, is an asset physically distinct? A building, if you have the whole building, certainly that's physically distinct. A floor on a building is physically distinct, right? So if it is not physically distinct, do you have, and it represents a portion of a larger capacity. So think about a pipeline, right? If you have the ability to flow your product through a pipeline, you have access to that asset or a capacity portion of that asset, then it is, does the capacity portion you have access to represent substantially all the capacity? So if I am putting my stuff into a massive pipeline with everyone and their mom, that's not substantially all the capacity, right? If I am putting it into a pipeline where I have 90% of that capacity, where I have a contractual right to 90% of that capacity, then that would be substantially all. So I would then assess, can I direct the use of the asset, which would be, do I determine when it flows, when we enter the system, when we where we go, and when we go, and at what rate and what volumes? Those would be the decisions that would determine who directs the use of the asset. So even if you have substantially all that capacity, if the gathering or transportation company gets to direct the use of it, then it is not a lease. So that's something that has come up quite a bit. So and obviously certainly a nuance to the industry. Go ahead, Brad, sorry.
Oh, excellent. And really the goal of 842 is just to put on your financials your minimum contractual liability and assets that you're virtually owning and controlling. So in simplified terms, that's what you're looking for. It's just anything that would be off balance sheet before, but really that is part of your business and you're owning it or directing it. In terms of contracts for oil and gas businesses specifically, a lot of these are E&P related with midstream, but any kind of transportation service agreements. So service agreements are what we're talking about here, things that don't say lease on them. They say services, but really they could have a lease. Compressors are the big one, compression service agreements. Any rig and drilling operations, especially since rigs are usually used by a single E&P company at a time for sometimes long periods of time. And any refining and storage arrangements, like Jordan was saying, if you're getting an entire tank to yourself or an entire pipeline to yourself, or mostly to yourself, then that could be something you got to look at.
Go for it. Well,
go ahead. Go ahead, Jordan.
No, I was just
going to say, maybe you can open the poll.
Yeah, and then I'll respond to the question when you're done there, Amy. Sorry. Go ahead.
No worries. So the third polling question is up. It's based on this info. How many contracts does your business have that require further analysis to determine whether they qualify as a lease? And there's a handful of options below. So please select your response and hit the submit button. And then while they're responding, Jordan, go ahead, and I believe you were going to get to it.
Yes, ma'am. So there's a question here about repeating the capacity portion. So again, we talked about is the asset physically distinct? So a compressor, a vehicle, a floor on a building, those would all be physically distinct assets. So then if it is not physically distinct, but it is in fact capacity or a portion of capacity of a larger asset, then it comes down to, do you have access, a contractual right to access substantially all that capacity. So if I am commingling my commodities with every other producer, and I have but a portion of that pipeline, a portion of that gathering system, or access to a portion of those things, then that is not. I don't have the ability to direct the control and use. I don't have an identified asset. I don't have access. That is not a lease asset because I do not have substantially all the capacity. Whereas if I have a pipeline where I have a contractual right to load 90% of my commodity to that pipeline, to that gathering system, something of that nature, then I do at that point have substantially all the capacity of a larger asset and would then have a lease, assess that for a lease. Because now I have the asset part, now I have to determine, do I have the ability to direct and control the use of that asset, which again would be who gets to choose, how much commodity I ship, when I ship, to where, all those decisions, all those operating decisions. So, all right. Thank you, Amy.
Thanks, Amy and Jordan. Okay, so most of you, 40%, said that 1 to 10 contracts is kind of your contract pool number, and that seems a little low for Jordan can chime in here too, but sometimes there's more than you think.
So to a previous slide, the point of a previous slide, be careful. If it says service agreement, take a look. Is there equipment necessary to perform that service? And then you really need to dig in. And even more from that, pull your payments and look for recurring payments because there may be stuff out there you don't even consider. Office equipment, certainly, copiers, et cetera. Now, remember materiality and all those things. So, yeah, go ahead.
Right, thanks. 11 to 20, that's kind of what I've seen personally, and some with hundreds. All right, so now we're getting into our first example. This is E&P Inc., an oil and gas producer, enters into a contract with Drill Services Co., nice and generic, typical oil and gas name, to provide a rig as well as personnel to operate it with the plan to drill multiple wells. Drill Services will deliver the rig and the people to operate it to the well location. The contract specifies, the contract has specifications on the minimum drilling performance, the working condition of it, the output capacity of it, and Drillco must maintain it enough to keep it functional. So standard repair and maintenance. Where this is at, it's not very practicable to go out, and it's not easy to go get a new rig once this rig's delivered, and it's also, again, not economically incentivized for Drillco to substitute it either. It will be operated by Drill Services Co.'s employees, but ultimately supervised and directed by E&P Inc. And then E&P has the authority to direct which wells to drill, when it occurs, and whether the methods to complete the drilling are acceptable. Standard downtime and regulations are not indicators, are normal and not indicators of directing these. That probably should be on the next one. But given these facts, I'll let Amy give the poll to say whether this contains a lease or not.
Yeah, so this one should be pretty quick. Does this appear to contain a lease? A, yes, or B, no?
And while we're here, so In this scenario where we have the contract for a rig and a rig crew, and so we would be charged one rate for the rig and one rate for the rig crew. That would be an example of a lease component and non-lease component, right? And so I think you would certainly want to combine those any of these components there. Shazam!
With that practical expedient.
We're the greatest teachers of
there
all
you go.
time. Yes. That's not an expedient. That is an accounting policy election. So it carries forward. Not
sorry.
You're good. All right. Onward we move.
Yeah. So the true answer is it depends. But given these circumstances, it does contain a lease.
Yeah. No, that one.
Because
there's no appear. That one's a lease.
Okay.
For sure. Right.
Well, others just hate to say for sure.
Yeah. Based on what we know, no, that's a lease. There's a rig, a certain level of capability performed, and then there's yes, drill codes folks are out there and they have the ability to shut it down for certain safety and standard operating due care, but we determine what wells we're drilling, we determine the depth of those wells, all those things. So that's certainly that. You would want to to answer a question as well here. Yes, you would want to combine the lease and non-lease components into one lease contract, right? For that drilling rig. Those are, and even on that, those are really hard to separate from each other. But that would be an example of a non-lease component. So yes, you would combine those. You would certainly want to combine, in my opinion, combine those, and then you would have your lease liability and right of use asset from there.
And if that non-lease component is variable, Jordan, what would be the
correct? So actually that's a great point, Brad. To Brad's point, the non-lease component here of a rig crew, even in this scenario, wouldn't go into our lease payments because most likely because it is variable and not tied to a rate, right? They are paid X amount per hour or something of that nature, right? So that if they say it's $2,000 a month for the rig crew, then that's not variable, right? But if it is, we will provide a rig crew based on standard daily rates, et cetera, then that would be variable, and we're not going to know what those folks are. That would not go into our liability payment anyway.
Excellent. Great answer. All right, we've got example 2. The famous Dutton Ranch, a world-renowned well operator, enters into a 3-year service contract with Big Time Services for compression agreement related to several of Dutton's wells, the production of gas from those wells. There is an optional 1-year term extension available at the end of that 3 years, but it requires both Dutton and Big Time to approve it for it to get exercised. There is a monthly service fee charged along with additional fees for chemicals used, like lubricants, antifreeze, etc. And Big Time agrees to make the compressor available, kept in working condition, and capable to compress the gas to required specifications, but may not have the exact model number and be the same. They just promise to give you a compressor that will help you do it. But this will be used solely for Dutton's gas production, and Big Time holds standard rights of duty and care, kind of what Jordan was talking about with the rig. And it includes the ability to substitute equipment if it goes down or if needed. And Amy, you want to launch this one? Does this contain a lease or appear to contain a lease?
Yeah, so this is another quick one. A, yes, or B, no. And then while you're responding, I do want to let you know that if you want a copy of today's slides, you can download them from the folder that says slide deck and handouts. And then we're also going to be sending them via email tomorrow, along with a recording of this webcast.
For only $9.99. Just kidding. This is free. All right. You know how many? It's only 80%. We'll leave it open another like 10 seconds or so.
Yeah.
Everyone was tired of my jokes.
Okay, and, here are the results.
Interesting. So the answer would be yes on this one as well. And I'm curious as to the thought process behind the no, and maybe Brad said something misleading. I'm going to blame him. So their ability to replace their ability to, the lessor's ability to replace it for maintenance or, because it is down, it is not a substantive replacement provision or anything of that nature. So we have a piece of equipment out on our property, and we decide when that. So it has to be. So if they say that there's a compressor with X amount of horsepower, right? Or if they say it's a such and such brand, back to the Ford F-250. They say we're going to lease a Ford F-250. That is an identified asset, right? And again, their ability to switch it out does not necessarily mean that it is a substantive provision to substitute. They have to have the economic incentive to substitute as well. So if you have a contract that says you're going to give us X amount of horsepower, they would have to switch it out for a similar constructed asset. And so there likely would not be an economic incentive to switch that asset out. And also certainly the ability to substitute equipment when needed for maintenance and repairs explicitly is stated to not be a substantive substitution, right? So perhaps we tricked you and we're not as good at teachers as I previously thought. Definitely the real answer. I know the substitution is what hung me up initially, because like you said, I wasn't really thinking about, do they have incentive to do so, and is it really going to happen outside of it breaking down? So I think conceptually, substitution rights are rarely substantive because of that economic incentive. Again, if you do not know that they have an economic incentive, it is presumed that they do not. So absent something very specific, I would anticipate that substitution rights are, would not be substantive. Now, there certainly would be if you're talking about widgets or things where it's very low cost to move things in and out type of situation.
Jordan, do you want to discuss the term considerations with that optional extension period? Yes, so we'll get into this a little bit more, but we've really hit over all these things. Again, that compressor is one component of the compression services agreement. There may not be anything else in there. There may be other equipment in there, and so that's when you would, again, if you have another piece of equipment, you would assess both of them. So you may have two lease assets, right? And you would have to allocate that consideration, or the lease payment, which is the consideration. So the term of the lease, I think that this is one of the more involved or important assessments throughout all this. So when we're assessing term, the term, and this one is actually straight from the guidance because I don't want to twist words. It is the non-cancelable period plus periods covered by options to extend, which is controlled by the lessee if the lessee is reasonably certain to exercise that option. To terminate, which are controlled by a lessee if lessee is reasonably certain not to exercise that option. And then any periods covered by the lessor. So if the lessor controls an option to extend, so if you have a lease 3 years, at the end of that term, it will continue for 1 year unless terminated by the lessor. It is presumed the lessor will not terminate that lease. Or
3 years plus a 1-year option to extend, controlled by the lessor, it is presumed that the lessor will extend it. So you would have, in those two scenarios, a 4-year term on the lease. So when you go to calculate your lease liability, you would use that 4-year term. That would also then play into your assessment between operating and financing, because you now have a much larger liability, or at least in total of lease payments, so you may get closer and closer to finance lease. The longer that term goes, you're going to get closer and closer to financing leases. So those things are pretty straightforward. Where you really run into judgment is, and it's throughout the industry. You have a lease, and we talked about this briefly last time. You have a 2-year lease, which then renews on an annual basis unless either party, lessee or lessor, provides 1 month written notice, 12 months written notice, something of that nature. So when there's that annual or monthly renewal, you have to assess, this idea of a no more than an insignificant penalty. So if I have a 2-year lease that automatically renews for a year, absent either party terminating it, you have to assess, can both parties terminate with no more than an insignificant penalty? So when you're determining an insignificant penalty, it is not just I got to pay $5,000 to break this. It is all the economic costs. What's my lost revenue? What is my economic downtime? What are the costs to take that piece of equipment off and bring a new piece of equipment on? How vital is that piece of equipment to my operation? If you have a very unique and specific piece of equipment, it's probably more likely that you're not going to want to terminate that, right? Because it's harder to get a replacement. It may be more burdensome. To me, if you have, there are but many compressors on this earth. If you have the ability to walk away from a compressor at that point, where both parties can terminate, right, with written notice, and you pay a nominal fee, or you got to pay to get the piece of equipment off, and it's not an expensive type item or a significant. Then I think that the lease term stops. So I have a 2-year compressor lease. At the end of that, either party can cancel it with 12 months written notice, and all I have to pay to do so is to take it off my well site. If I am in the middle of West Texas or South Texas or Oklahoma or a lot of places, that lease is no longer enforceable. My lease term is that 2-year term. It does not include any extension or renewals. If I'm in the middle of the ocean and I got to pay to get one out and one back in, may be different. I may have a longer lease term in that scenario. I may be less likely to not exercise that option or to exercise the option to terminate. So evergreen contracts are extremely common. Once they go evergreen, if you can terminate it without something significant, without losing all your revenue, then not all of it, you get what I'm saying. Hopefully, if you can walk away from it, then your term is done, right? And I'm not going to sit here and tell the world that they should estimate how long they're going to keep a evergreen contract when commodity pricing is slightly volatile. So that's just something to be aware of. Yeah, something to be aware of. Again, if it is a unique or precise piece of equipment, then I think it's a much more detailed analysis. Absent something of that, once it goes evergreen, your lease term is done and you move on with your life. Sorry.
And it hasn't been explicitly stated, but reasonably certain has been interpreted to mean 90% or higher. So you'd have to be pretty dang sure if you did go that route of estimating, and I wouldn't recommend it. But in any case, you got to be really sure you're going to take an extension if you're going to assume it in their lease calculation.
So there's a question here about if the term is evergreen to begin with, it doesn't meet the definition of lease. So if it's evergreen and there's no termination option in there, then yeah, that doesn't really. But if it renews on an annual basis, so if you have a contract that is annual with recurring annual options, then you would effectively have to assess the likelihood of exercising those options, right? Whether you're reasonably certain. So again, where you would see the no definable term would be a perpetual, type of thing. So an evergreen lease, in theory, because it can be acted upon by either party to terminate it without a more than insignificant penalty than you would. So yeah, and I don't know that I see any that are, and maybe I'm wrong, and I very likely am, right out the gate recurring. I guess even at that, right? So right out the gate, it says this is a 12-month lease that automatically renews on a 12-month basis. You right away have a 12-month lease. Now, if you have a month-to-month lease from the start, you got a month-to-month lease. But there's some term in there from the start. And if it's a day, then it's a day. But the renewal options aren't right away, I guess. So hopefully that answers the question. And if not, please feel free to follow up.
Yes, we'll give our emails at the end. But great questions from all of you. Ryan's been on fire. Great questions, and glad you're asking them. So now we get down to an example. This is a compression service contract. It's 2 years, delivered conveniently on 1/1/2022. How about that? And then there's a monthly payment of $1,000 to start, due at the end of each month. The first year, in that $1,000 includes the $900 base rental fee and then $100 in maintenance. It goes up to $1,200 a month after 12 months. And the discount rate chosen, which was the treasury rate for a 2-year period, was used at 4%, which gave us an initial present value of the payments of $25,000. The quoted value of the compressor, or fair value, is $40,000, and there were no other incentives or initial deferred costs or direct costs that would need to be capitalized. So going to our lease analysis, this is, you can find this in many spots, but outlined it here. When analyzing whether it's operating or finance, the first thing you look for is transfer of ownership, which we did not have. There was no purchase option, so NA there. The lease term is for the majority of the remaining economic life, accepted to be 75% or higher. We're going to say that compressor is going to last longer than 3 years. And then the last one, or second to last one, the present value of payments plus any residual value is greater than substantially all of the asset's fair value. Another favorite term of the FASB, but that's also been accepted to be 90%, given that our present value is $25,000, but our fair value is $40,000. It would not pass that test either. And then the last part is if it's of such a specialized nature that no one else could benefit from it, or in other words, you're the only one getting benefit from it its entire life without it being drastically changed, it would be a finance lease. But it's an operating lease based on this. So we show the first slide here is just the impact year by year. You can see the lease expense, whether you were doing 840 or 842, it should be $13,200. Your straight line red each year. That shouldn't change. Your balance sheet on day one, at the beginning of year one, your present value will come on. So you'll see right use asset beginning of year one, the liabilities, those will continue through the end, and your cash flows will be your actual cash payments. Here's kind of showing a nice tick marked table here. So you see our cash payment by date on the left. That's going to take us to our lease liability and cash payment when you pay it, knocking the liability down. The straight line rent figure is just our payments divided by 2. That less your interest component, which is the C letter there, that's 807 and 308. Straight line less interest without any other, lease incentives or other costs that would affect it. Your RRUS is going to go down by your straight line rent less interest. It's not a super easy conceptual formula, but it's essentially the plug to make sure that your expense gets to straight line.
Yeah, so it's basically a plug to make sure that you are smooth, right? Under an operating lease, it should be a much smoother expense recognition. And just to, I know we mentioned it, but on the journal entry there, you see the 2 lease expense line items. Those 2 items are broken out just to show the point that Brad was making there. But those 2 items will collapse into each other into one single lease expense line item on the financial statements, or on its way into the financial statements. That thing is going to be buried in well within LOE or wherever it may be.
Yeah, and just to clarify, the interest I calculated was monthly, since we had monthly payments. So if you're trying to do 4% times those annual amounts, it'll be a little off. But breaking it out monthly, calculating interest, just like a debt amortization schedule, will get you those figures, and it should bring your asset down to 0 by the end of the lease. All right, Amy, you want to open the poll? Compared to the old guidance, which financial statements do operating leases have an impact on? Balance sheet, income statement, both, or none of the above? And one thing to consider regarding the, sorry, go ahead, Amy.
Oh, no, I was just going to say it is open. They can respond and submit their questions, but go ahead.
Excellent. I was just going to say people do like to take the easy route of going with the risk-free rate, but keep in mind that a lower rate will result in a higher present value, so bring on a higher liability up front. If you determine a supportable incremental borrowing rate, it's almost certainly going to be higher than the risk-free rate, bringing on a lower liability at the beginning.
So that also raises an important point there of it's something to be aware of, right? Is the right-of-use asset is a long-term asset. The lease liability is both current and long-term. So you are going to have current ratio impacts for lease implementation, right? So that is something, obviously, with any lenders, maybe, obviously getting ahead of at this point, getting on at this point, and making sure that we're comfortable with, that they're comfortable with, and they understand, and we're going forward from there. And then we'll, sorry. Go ahead, Amy, I'm sorry.
We can close it out.
Yeah, let me close this out for the results. There you go.
Oh, interesting. Well, the balance sheet for sure is affected. Or can we just go back to show this? So the balance sheet is definitely affected. You have the right-of-use asset and lease liability. For operating lease, your lease expense should be no different than it was before. Before we just had our straight line rent, debiting expense for the straight line rent, crediting cash, and the difference into deferred rent. Now, the mechanics you saw on the slide get you to the same spot, but it should not change. It's kind of a good check figure while you're going through this to make sure that what your expenses have been before is the same after. But the balance sheet is the primary financial statement affected. And that was the goal of this standard. Okay, so now we're going to go into a finance lease. And I will say, generally vehicles very often are classified as finance leases just because vehicles depreciate so dang fast and lose value so dang fast. But this is a 3-year contract with the delivery occurring, again, very nicely on 1/1/2022. Even more conveniently, has yearly payments, yearly payments within no, monthly payments, apologies. $15,000 total in the year and $1,000 total in maintenance fees. And we're electing to combine lease and non-lease components. The initial present value of the payments are $45,000. Quoted Kelly Blue Book value is $47,000. This was accounted for a finance lease due to that present value being greater than 90% of $47,000. So we decide we're going to account for it as a finance lease. Here shows the kind of the effect of a finance lease. This is, Jordan can correct me if I'm wrong, but there shouldn't be any change from if it was a capital lease. If you were accounting for it as a capital lease before, under the old guidance, the mechanics of accounting are the same, except for the term right of use asset is now what you see on the asset side.
And again, when we're presenting these, we cannot be commingling the operating, lease liabilities, and the financing lease liabilities. And yes, you can question on the cash flow about the cash payment versus the lease expense. Since that difference really is effectively amortization in a lot of ways, yes, it is not required, but it is a best practice.
Are you saying best practice to present the cash payments for the leases, Jordan, separately in the cash flow?
To reconcile the difference between your lease expense and your cash payments as non-cash lease expense in the at the top of in our cash flow, excuse me.
Yeah, and the disclosures as well are another place you can put that in your footnotes.
Well, it's certainly, the disclosures are more prescriptive as to what is, but again, that non-cash portion is not required to be presented that way on the cash flow, but it is a quote-unquote best practice.
So you can see here, this is similar to debt. So you have an interest expense each month. Your lease payment will go down by your lease liability will go down by your lease liabilities after your interest is added to the liability. And then the amortization of your RU asset. Instead of all of it going to lease expense, like an operating lease, you'll see it hitting interest and amortization expense. And then you'll also see the cash flows, and the financing section will include the principal payments on your lease. Payments with everything but interest. So a nice little table here just showing, like, on day one, your asset and liability should equal each other with the lease starting on that date. And then this is just a look at the entry to record it also. You got your interest, expense, amortization, your short-term lease liability, cash and accumulated amortization. Technically, you'd probably also have an entry moving a month of long-term liability into your short-term if you wanted to get technical, but not important. All right, and so that's the last example. I know we've got 10 minutes left, but I think that's enough time. So this is covering a pre-existing lease. So a lease you had before day one of your implementation, and it assumes you account for everything properly. But the effective date for this business is 1/1/2022 that we're assuming. Lessee entered into a 5-year lease of an asset on January 1st, 2021, with annual lease payments payable at the end of each year. The lessee accounts for it as an operating lease prior to 2022 and properly classified it as such. And when they entered the lease, they capitalized deferred initial direct costs, which previously were to be amortized over the lease term after they're capitalized. And there were $400 remaining in those unamortized costs at the adoption date. And then before, on 1/1/22, there was an accrued deferred rent liability of $1,200. And there were 4 lease payments, 1 payment of $31,000, 3 payments of $33,000 remaining. You can see I poorly shrunk the recognition under ASB 842 label in that green line, but the bottom table is supposed to reflect after adoption, and the top table is ASB 840. So in 2021, we had this schedule, and I broke out all of the components of everything just to better clarify it and illustrate it. But we have
components, when you said components, you mean pieces of the calculation, not like lease components and non-lease components and stuff.
Yeah, sorry, I can't say components anymore. Forgot.
Yeah, it's one of my favorite words. So.
Yeah, I love it. I love lease components.
Yeah.
And
plays well at parties. One of the big things here that we're really trying to show is that in these scenarios, so absent any unamortized indirect costs or deferred rent upon adoption, your lease asset and your lease liability will equal each other. Certainly for an operating lease. So where you have unamortized direct costs or existing deferred rent, you will have a difference upon adoption of the lease liability and the ROU asset. So it confuses people when the lease liability and right of use asset are not equal. And so this is really trying to show that that's what's happening here. And again, you can really see as well the rent expense, the lease expense, rent expense, G&A, for the office building, whatever it may be, is consistent between the two methods, right? Between historical GAAP and 842. The real thing here, and this all comes down to the SEC doing a study 15 years ago to get a better understanding of off-balance sheet risk. What liabilities were companies committed to that investors were not seeing reported on balance sheets. So they want it all on the balance sheet, and wildly underestimated some of the complexities that come up with this. And again, on operating leases, there is one line item for the expense, right? So the breakout that we've been showing today between the interest component and the other part is really just to show how we're getting the calculation. But at the end of the day, the operating lease expense is just one item over time. So you would probably later class part of rent expense. So yes, effectively you're gonna the same way you would.
You want to read the question, Jordan?
Yeah, sorry. So basically, if you were billing through JIB, you would probably then reclass part of rent expense to AR, but could split reduction between rent and interest. I don't know that you would need to split it between rent and interest because it is only one item. It is the operating lease expense, right? It is again done here for that illustrative purposes, and maybe it's done that way internally as well. But no matter where you net it down no matter where you net that non-op expense portion to, you're going to end with the same operating expense combined, right? Operating lease expense combined, because it is one. It's one line item. It is one number, and so how we net it from the JIB purposes on the expense side is not going to impact that. Since interest is non-cash, this should be backed out in cash flow from operations. Correct. That is accurate. And then we're going to go back here about where did we go?
And your cash paid for interest will still be on the bottom of the cash flow as well.
Correct. So we're just going to make it unbelievably complicated from a disclosure purposes. And I think that is one of the big takeaways as well, is the complexity with disclosures. So getting ahead of that, making sure that you have your arms around all the data, all the payments, and then you can work from it. There's plenty of SEC filings out there that are very vague in their disclosures about, they say, this requires judgment. Cool. Any ideas what judgment was used? But that's certainly something like that. Correct. And the cash, so your cash and your expense are going to not really be equal, right? You have this really weird scenario that's happening there, and yes, that's going to make some complexity. And regarding materiality, is materiality based on the monthly or life of the contract? For example, a $100 a month for a printer for 3 years, threshold is $3,000 to be capitalized. So, obviously the FASB is going to offer absolutely, well, so the FASB is going to offer absolutely zero guidance on materiality on that, right? So there's this discussion of it is entity specific, and you really assess two, right? What is your existing capitalization threshold, and so what would your present value? Yeah, what would your present value be of that lease, right? So you take your $100 a month, 3 years. Is that present value? Is the present value of that greater than your capitalization threshold that you currently have? So there's that analysis. The concern is maybe it's not greater than that capitalization threshold, but you got a lot of those printers, right? Or you got a lot of those computers or something of that nature, and you're leaving a lot of liability off the books, right? And so it's making sure that we're capturing that aspect of it, because, and so this is from a Deloitte guide, the existing capitalization threshold does not take into account the liability side of the balance sheet. If an entity wishes to establish a threshold that will be used to avoid accounting for both ROU assets and lease liabilities, it must consider the materiality in the aggregate of all its ROU assets and related lease liabilities, right? So when we're talking about capitalization threshold, we're paying that invoice right away, or we have that one item, that one asset. In this scenario, we have an entire series of liabilities that we could potentially be leaving off the books that are going to be there for a while. So that's that consideration. Any questions we didn't get to, I greatly appreciate all the questions and the active participation. Hopefully there's value in this. There's, you can go in circles on this. It is extremely complicated. At the end of the day, getting your arms around what's out there, what your risk is, what contracts you have is really the most important part. And once you're there, it can, a lot of times it's not as daunting as it may seem, but certainly don't hesitate to reach out for any of the questions we didn't get to. I know there's one in particular we didn't regarding the litigation, which I will follow up on. So,
can I just clarify something real quick, Jordan?
No, you're not allowed. Feel free.
All right, well, then I'll just mute you. I just wanted to say that I don't think I have that power or capability, but the column that says ROU asset net, that's your true ROU asset balance. I showed it as net, but on your trial balance and entry, the ROU asset base column is not a separate account. It's just, I just wanted to show the components of what's making up your first ROU asset entry. You'd be reversing out your deferred rent that was accrued at the end of 2021 and your capitalized IBCs, and those roll into your ROU asset. Just wanted to clarify that in case people were starting to make a big chart of accounts with accounts you didn't need.
All right.
All right.
Do you want to go over these
resources
out?
Oh,
so
sure.
If I may,
all the usual guys.
Well, that plain English guide there in November 2021, it really addresses things that management should consider when going through this process. Some of the stuff they identified is really consistent with what I've seen. Yeah, take a look at that. I apologize, I'm chewing sour candy in y'all's ear right now. Sorry.
And again, we kind of went through the question time, but if you want to email us, there's our email. Amy does have to give a closing farewell, but thanks everyone for your time and engagement. We really appreciate it and hope it helped.
All right. Thank you, Jordan and Brad, for all this information. And yes, thank you to the audience for being engaged and submitting your questions to help guide today's conversation. And as I mentioned, if we didn't have time to answer yours, we will do our best to follow up with you after the webcast. And feel free to reach out if you have additional questions. Their contact information is in the PDF that you can download and also in your console. And in the upper right-hand corner of your console, there's a banner that you can click on to be taken to the registration page for our next webcast on energy leases for power and utilities and renewable energy, which will be October 5th. So definitely check that out. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks should you have difficulty downloading it now. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care.